Welcome everyone to this roundtable on how to build a resilient economy. When a crisis hits an economy, and a crisis like a pandemic hits an economy, the whole system approach to tackling the challenge has to be brought about. Now, there are issues of macroeconomic stability. There are issues of internal distribution of credit and other financial resources. There are questions of social security. How we can be able to, not social, of small company security. How we can actually keep them afloat, help them tide over a phase of very bad financial results. Now, all these come together in facing crisis, and they're all part of the rubric of how to build a resilient economy. And for us today, we have a very good panel of economists. You have Ashima Goyal, who is an academic as well as an advisor to the government, and so therefore is clued into policy. We have Neelkanth Mishra of Credit Suisse, who is closely watching the economy and talking about it. Abheek Barua, who is a bank economist, and who also is clued into what has happened in the economy and trends there. So welcome to the discussion and all the panelists as well. Now, the topic is how to build a resilient economy. I suggest that we start by each panelist making a brief opening statement, their initial thoughts on how we do this. And after that, we can go around. Perhaps we can ask the question, each other questions, or I can ask them questions. So shall I ask Neelkanth to kick it off? What do we mean by resilient economy, and how do we build one?
So the resilient economy is, of course, as the word says, something that can withstand shocks, and we have seen several shocks in the past year. The economy seems to have weathered it reasonably well, though one can say that the impact of the virus in the economy or on India or Indians appears to be a lot milder than it was in several other countries, which has perhaps helped the economy bounce back quite a bit. In general, though, if say futures are shocks and we don't turn out to be as lucky on the health side, it would be important for the economy to have a resilient financial system. I think even before going into the pandemic, there was a clear problem with our financial system. The aggregate credit growth was slowing, and it was driving down inventory levels across the economy, which actually meant that even as services GDP growth was holding up, there was a problem with manufacturing GDP as supply chains or several supply chains were starting to destock, most aggressively seen in autos. Going forward, if we need to keep growing at 11 to 12% in nominal terms, we will need a financial system which can continue to provide credit at 13 to 15% growth. And that's one area where policymakers, I think, need to focus, that the financial system needs to be reasonably well capitalized. There needs to be incentives to growth. And that's definitely something to focus on. The second area of resilience, and this is something that I think was what drove a lot of caution in the government and the RBI in the early stages of the pandemic in terms of a policy response, was what happens to our external balances. So historically, given that we have been importers of energy, we import a lot of gold, we import a lot of capital goods, and increasingly electronics, how do we reduce our dependence on external capital? And that's not to say that every country must have a current account surplus, but at times like these, it actually limits the government's ability to intervene and sustain growth. The third aspect has to be in the government's policy toolkit. So it is one thing to be willing to spend. The second is, can you spend without leakage and in a very potent manner? And I think what has happened over the past year is that a lot of gaps have been exposed in the Indian government's I would say even the general government's toolkit. If we need to target the urban poor, there is no scheme available. If we have a very large informal sector, and there is no direct way in which the government can address their pain. And while by now I think it's reasonably well documented, we all know that the government is also fully aware that the informal sector and the urban poor are badly affected. Uh, those are segments which I think will continue to struggle for even as the rest of the economy is reviving. And our only hope is that the economic growth kind of trickles down to these segments as well. So these would be, I would say, the lessons over the past year that we've learned for how to, if we address them, we'll be much more resilient for future shocks.
Your initial thoughts, Abhi?
I'm just going to talk a little more generally at the beginning and just emphasize the fact that we are perhaps in an era of shocks, both financial and other shocks. And I think, policy making must recognize that. And perhaps, one thing that has happened is that we are increasingly talking about, counter-cyclical buffers in the financial system and the banking system, so forth. But perhaps we need to build buffers for these extreme events, which seem increasingly likely, and the gap between extreme events could actually become, shorter and shorter. I think Barry Eichengreen predicted that every 9 to 10 years, we'd have a crisis of some sort. But perhaps the duration is shorter. And I think the challenge really is to make crisis management or the management of tail risks an integral part of regular policy making. So we are sort of setting aside something for a rainy day. And also in making policy, there are two things that need to be sort of recognized and in the design of policy going forward is one, minimize distortions in the kind of response that you have to a crisis. And I would see something like inequality as a distortion. I would see perverse incentives in the financial markets, the extreme example of which is what happened with the GameStop stock in the US. That to and also to have a very clear strategy for kind of rolling back the most extreme response to the crisis, and not let the economy and the markets get sort of addicted to largesse at its most extreme. I think this is a big challenge going forward. We saw it with the taper tantrum and so forth. And the last thing that I'd like to say, and which I think this crisis has highlighted, is, and this brings me to the question of government and governance in this business about maximum government and minimum governance. I think one of the things that we should really be proud of in this particular in handling the crisis is the way uh, you know we used our established systems that we've used for epidemics like Kala Azar and so forth, the surveillance, the contact tracing, and the administrative apparatus, right from the district level to the central government level, the state government level. So we seem to have a very, very robust system in place which can be called upon. And I just speak from personal experience because my niece had COVID here in Delhi and my daughter had COVID in the UK. And the contrast between the way it was handled, my daughter was just left in the lurch without any, broadly, state support. No one even bothered to, call her to find out if she had gotten better or she was disease free. But whereas here, I think the systems have been very, very robust in relative terms. Of course, it has its limitations. So I think we also need to think of the structure of, governance, for the lack of a better word, administration, systems of service delivery, which I think is fairly strong. So I think in a number of areas need to continue with this principle of maximum government, and that will sort of deliver us from, more effectively from the worst impact of the crisis.
Ashima, over to you.
Thank you, Arun. I think I'll start with where Abheek ended, because one of the things that is really surprising in this current COVID crisis is how much better we are doing than expected in the beginning. Worldwide, there was, because India has a relatively low income per capita incomes, congestion. We were expected to do much worse than we have, and we've escaped a second peak. And so I would, taking the topic of this session, that we actually are quite resilient. In fact, these days, there's some media I'd read, they're saying India is the most resilient nation in this COVID crisis. So how do we understand this, given the expectations and given the reality? It seems we are not understanding many things about me. For one thing, I'd say that the preemptive early action helped flatten the curve and give the medical system, the systems time to rev up. As Abheek was saying, they worked well. It wasn't just inherited, it was also planning, because this was a unique kind of pandemic we haven't had for many, many years. So, and another thing to notice is that in a democracy, in a very noisy democracy like India, it's very difficult to take tough actions, because if people who are affected really start shouting. So there was so much shouting internally as well as from external experts, but over the long run. So the thing about, you have to be very determined as a government to inflict short-term pain, which will benefit in the long term, and hold with that path. So I think that is also important. And the other reason we've done better than was widely expected, I think, is that we have achieved a degree of diversification. For example, manufacturing, obviously with the lockdown, absolute slump, but agriculture did well. The economy itself has services, outsourcing, and the digital economy held up very well. And we have a lot of expertise in that. Then early on, in these talks, early summer, we would be asked to talk very often on these issues. And I give this example from endogenous growth theory. There is this idea that if there is a natural catastrophe and a lot of physical capital infrastructure is destroyed, but human capital is not, then very often you see a sharp revival, because those are the people. And I think as Indians, the other thing is we don't have, given our numbers and the fiscal constraints, we can't have the kind of transfers that advanced nations have been giving. So people have to fall back on their own resources. And there's a lot of substitution in directions where it's possible to continue to grow. And we saw a lot of that, I think. So necessity was a driver of resilience also, I think. And but from the policy point of view, I would say another reason for the surprise was that, after the global financial crisis, there was too much stimulus. And after that, too much tightening from the macro, even the financial system was in trouble. So overall, there was just too much tightening. It was not counter-cyclical at all, and too much of a focus on structural reforms. So we did not see, this, I think Neelkanth started by saying that we were already in a bad shape. That is not true, in the sense that we had done enough reforms to be at the cusp of recovery. And if you look at the high frequency numbers, people very often say that growth was continuously falling before the crisis hit. But if you look at the high frequency numbers, I think we had liquidity tightness until the summer of 2019. And then it reversed. And by February 2020, we had growth coming back. But because then in March, COVID struck. So for the year as a whole, growth was lower. So we saw the same thing now after COVID, because we saw a lot of liquidity support from the Reserve Bank, warranties, if the financial sector was in such a bad shape, how would a lot of the stimulus came through the financial sector, using government warranties that compensated for the risk aversion. Yeah. So, and the current figures for banks, again, a lot of people were saying that, see, banks, I think Abheek should tell us more about this, but so many banks are coming out with their results that their forecast of NPA is much less than it's actually going to be, and recoveries are, because the country is seeing a fast recovery, so they're not going to be so badly off in terms of the quality of assets, etc. So, but I agree that overall we do need more counter-cyclical policy. Yes, we should learn the importance of counter-cyclical policy. I think now I agree with Abheek again that when there has been a large stimulus, our problem after the GFC was that we didn't roll back the stimulus fast enough. There was over-stimulus. So I hope to see policy being more balanced now, with a lot of the stimulus being withdrawn gradually, not too fast, not too late. And then I think also the timing of, given our resource constraints, obviously there was a lot of pressure for the government to spend, but when supply is absolutely shattered, there's no point pumping up demand. And I think that since 2011, we've seen a slowdown in investment. So for the government to focus on investment now, I don't know how quickly they will be able to spend, but if they can do that, then multipliers are much higher for investment. Given the supply bottlenecks we tend to have, if you are focusing on investment, it can crowd in private investment, then you'll see less inflation, more monetary fiscal coordination, and better growth going forward. So, and I agree, again, someone had said about the poor having more safety nets. I think we've learned about migrant workers. And so, having better enumeration, better facilities. But again, I think we should be proud when we compare the times of the Great Bengal famine. Nobody died of hunger. It's not just the government. So many NGOs and other, we have built up quite a strong horizontal democracy as well as a vertical democracy. So a lot of people were there, who contributed. Of course, given the lockdown and the migrant problem was terrible. And hopefully we'll build better facilities for such workers also now.
Yeah. So while we are discussing this in the wake of in the midst of a pandemic or its recovery, it's natural that we focus on what happened. But I think we could also look at, in general, another crisis, a financial crisis. Suppose a sudden spike in inflation that completely disrupts our balance of payments or whatever. How can the economy remain? As far as the pandemic is concerned, I think the general discourse doesn't take enough note of the fact that a country like Pakistan, with barely any healthcare facilities or the ability for the government to deliver relief or healthcare services, also has survived the pandemic fairly with minimal damage. And then if you look at zero ways in Delhi, Karnataka, other states, it would seem that about half the population has developed immunity for whatever reason, which is a far cry from the level of infections that were noticed or reported. So the pandemic and its effect on India is one thing, and how we can actually stay resilient in the face of another crisis, like say the global financial crisis, is separate. Now we have covered some issues such as the banking system and the financial system being able to have the kind of buffers that are required to withstand a crisis. We talked about the need to have enough, say, foreign exchange reserves or possibly swap lines to tide over a balance of payments crisis. We need social safety nets. But what about the corporate sector? How resilient is the corporate sector in itself? In terms of leverage, in terms of the ability to flexibly respond to a crisis like this, and what is there, and what else can be built up? Neelkanth?
Yeah, so as I have the mic, I can respond to some of the things that Ashima mentioned. So I think that I agree that the banking system, in fact, as advising our investor base, we have been saying since September that the best investment is the banks because their NPAs are not going to be high at all. In fact, the cleanup of the NPAs in the banking system, which started 2015-16, has mostly run its course. There was a time when 100% of pre-provisioning operating profits was being provisioned for bad loans. That number is about 60-65 now. I think normal is more like 35-40. So bank earnings will grow. I think that's the point that you just given. The point I was trying to make was that the ability of the financial system to grow or to fund growth is where the problem is. That the very large PSU banking system does not incentive. I mean, there's no natural incentive to lend, and I think we need to address some of those issues. Coming to the corporate sector, see, and this is where these pandemics and these kind of crises, from a pure analytical perspective, are very educative. During the pandemic, what has happened, and as you would find in a jungle where, suppose there was a shortage of water, it is the big and the bulky ones at the watering hole who get all the water. So what has happened is that most of the large firms have used their bargaining power to get the best from customers. I mean, there have been companies already at record high margins which have actually told their suppliers that, we will pay you 1 month later. There have been companies that have actually refused to give financing to their customers. So in the survival mode, what we have seen is that the profit margins of the whole sector, say BSE 100, even if you take a BSE 500, has actually improved quite substantially. How much of that they will be able to hold on to is something time will tell. I think what we have found is that they are what counts as fixed costs. So just to give you an example, in June quarter, we did a bottom-up survey of all the companies we cover. And what we found was that most of them had been able to bring down their fixed costs quite substantially. But when in the second part of our survey, we asked them, how much of these fixed costs will you be able to hold on to, fixed cost cuts you will be able to hold on to? What we found that more than 90% of the fixed costs would actually come back. Now, so my question was, why are these fixed costs? The way they are classified, maybe they are fixed costs, like say selling expenses. But if all of your salespeople are contractors, at times of crisis, you can actually just tell them, sorry, I can't pay you. And I think the large corporates are not where I think the problem is. We have found that they are actually far more resilient than would have been expected before the pandemic. I think the challenge is going to be in finding out how resilient are the small companies. And I'm not talking about companies outside the BSE 500. They are also gargantuan companies compared to what the average size of enterprise in India is. So it is the 10-member, 15-member, 50-member firms, and how have they been able to hold on to their business? Have they been able to hold on to their employee base? One advantage, and I think that shows a bit of resilience, which is not very desirable resilience, in the sense that if you are completely informal, all of your fixed costs can be adjusted very quickly, right? So I had written this note in March. Can we stop the clock? Can we stop the clock of fixed costs, salaries, interest, rents? These are the three biggest costs. And what did happen was that because if you have informal contracts, you can always say, sorry, I won't give you rent, or I will not pay you for the next 3 months. I'll just give you enough so you can survive. So that provides a level of resilience. But from a growth perspective, is it beneficial? And if we were thinking of a crisis 5 years down the line, should we assume that all of our economy will remain informal and will remain as resilient and flexible in the face of such dramatic shocks? And I don't think we should. And therefore, it's extremely important that we find a mechanism to help out small firms to just survive. Right? It is not, just like we help people survive, no one died because of lack of food. And that's, I think we should pat ourselves on the back for that. But how many firms have been permanently damaged? We don't know yet. The one area in the banking system, I think Abheek will know better, where we still have a lot of uncertainty is bad loans on the personal side, for bad loans given to small enterprises. And so those are the areas where I think we need to focus on for future shocks and pandemics.
In terms of, apart from the issues that Neelkanth raised, in terms of leverage that our companies already have taken on, and the ability to service these loans and move forward, that is one issue. But last year, companies also raised a record amount of debt from the bond market, which is also quite a sign of resilience. How has your experience been as a bank economist with the behavior of companies during our pandemic the last year?
Right. Let me begin by just supporting and concurring with Neelkanth on the fact that we are perhaps going to see a uh, decidedly K-shaped recovery, and some of the K-shape and the K-shaped recovery can uh, be driven by sectoral differences, by differences in other things. But the size is a very critical differentiator, or the ability to benefit from what seems like headline recovery. And I think we do have a problem with the smaller companies. And as sort of time progresses, we will get to know how much of the extreme measures, as he mentioned, that they took in order to just survive, they can hold on to. And perhaps we needed some kind of a fiscal mechanism of the kind, say, the UK, comes to mind right off the top, sort of their first uh, effort initiative was to sort of support and enable the mom and pop companies to survive. So I think that's one piece which seems to have that we've missed out on. The credit guarantee scheme, yes, it has benefited some smaller companies, but the really small really haven't got too much out of it. So I think that is a real problem area, and that's something we need to sort out. So support systems, you can call it a safety net for companies of very, very small size, which we call business banking in in our neck of the woods. But TK, we saw a very strange phenomena right at the beginning as the crisis unfolded. There was a rush from big companies to both borrow from banks, and because as liquidity was pumped into the system, interest rates and yields went down. There was a rush to build large cash chests in sort of anticipation of the worst outcome. So the feeling seems to have been that if you're flush with cash, you can sort of tide over the most extreme situation. But so most of the fundraising in the initial part of the pandemic was by large companies building cash chests. What we've seen is that, including some of the larger NBFCs, what we've seen, subsequently is that these companies now want to deleverage very actively. They want to sort of even sort of try and prepay their loans. Uh, and there is some both appetite coming from banks as well as appetite for credit coming from the medium-sized companies, which are, I guess, are now more comfortable with their cash flows, their sales prospects, and so forth. For the smaller, the larger small companies, pardon the contradiction, but they have been beneficiaries of the credit guarantee schemes. But there is a very large, catchment of both individual borrowers and businesses which take personal loans, and as Neelkanth was mentioning, who have either been left out of the sort of lending system because of risk aversion, or would find it very difficult. I mean, a lot of things have got masked by the moratoria, but once that is lifted and once actual the system returns to normal, maybe we will see some real sort of stresses in some parts of the banking system. It might not reflect in very large NPLs, but we will see concentrated stress in certain areas.
Ashima, in your response, will you cover two areas specifically? One is the level of international borrowing by Indian companies and the kind of potential it has to create some kind of microeconomic stress on that front in terms of cross-border payment obligations. Secondly, on the problem the previous two speakers alluded to, the structural non-access a large segment of our enterprises don't have to formal lending, and how we might actually overcome that as a part of building a resilient economy.
Yes, TK. So I think the jury is still out. We have to see what happens, because the kind of resilience I was talking about, that small person has in India, since you don't get that help, you have to survive on your own. So you have an informal network that supports you. And you also substitute towards where there's opportunity. Like one banker friend was telling me a lot of small companies are coming and asking for loans to make masks, you know, and other kind of home consumption, home delivery, etc., etc. So we have to see what they did. And also, I think there's widespread formalization going on with GST. It started, and so because of that, they have some access, some better access, some better accounts, and so on. So again, that might be a positive. And also, banks are now doing risk-based lending, which is a big thing. I mean, I'm seeing they're not just lending because they're told to lend, but they're evaluating. And so, to that extent, NPAs are those who have good business plans, etc. So that is a healthy thing. And to that extent, you'll see less distress in banks, and you'll see firms that have a temporary shock come out of it, but not those who are unviable in the long run. And that is a good point for the economy as a whole. Resources shouldn't be trapped in zombie firms. And then the third thing is like what Abheek was saying, that liquidity hoarding. You saw that in companies, you saw that in government was not making payments. But as liquidity improved in the economy because of the measures taken by the regulators, we are seeing large firms paying small firms. So then liquidity is percolating down, and that is helping the small firms also. So now to come to the borrowing, external borrowing by corporates, I'll just sort of quickly come to the first question you asked, TK, which is longer term, how are corporates going to contribute or survive? I think that we've handed our industry a very tough job in India, because before reforms, we had import substitution and total protection. They were used to a soft, comfortable life. Then we opened out and it was import competition, from China, and they were not, and we hadn't improved the labor, land, etc. market, which is very difficult to do in a democracy. You have to do it by stealth. I think the best way is state competition. But then what? So now we are moving to a more pragmatic kind of industrial policy, which I call export competition. Where you're giving, say, this PLI or improvement in other kind of, electricity supply, etc., and labor markets and so on. But you're telling them this is temporary, it's not forever, it's for 5 years, so they don't become comfortable and they have to compete and earn in exports. So therefore, I think that we might see one of the puzzles in Indian growth is that our share of manufacturing has not gone up. We might see this improve, labor intensive. There's a diversification from China. We can attract people in that. So, and the other big thing is that the way we were subsidizing, like Abheek or others saying that you should have pay small industry, but when you just look at the current budget figures, it's about 6 to 7% out of an average 13% of GDP, which goes in various kinds of in-kind transfers, food subsidy, and so on. We just don't have the fiscal space. And given our numbers that we have, 1 billion plus people, we're just not able to, and given our already high debt levels. So we can't give that kind of support. But improving financial sector long-term, and again, for Neelkanth, I'd say that you can't, today change suddenly to a banking sector, which is 10 times the size. It happens gradually with growth. And if you have the governance and things reformed sufficiently, I think we have seen enough improvement in governance that the banking sector will now go in step with industry. So we might see, a much healthier corporate sector, and borrowing from abroad, given the way we are, we are able to attract inflows. This is the time to borrow and to invest, as long as it's invested. So if they are investing and they're earning and overall conditions are healthy, I don't think we will. And also another factor is, I think Credit Suisse was responsible for this. That earlier after the GSC, there was 100 companies most indebted. When I look at the data, I can look at this data. Indian firms have the lowest debt among emerging markets. Households much lower than our credit GDP ratios are very, very low. We actually need to increase them. And so those 100 indebted firms are only in infrastructure.
Sorry, let me intervene because the firm is mentioned. So it was 10 firms. Our problem was not that credit to GDP is too high. Our problem was that just 10 groups accounted for 13% of outstanding loans. And we called them house of debt. And for your information, 7 out of those 10 have gone bankrupt. So so it was not
No, but it
rumor
was not.
mongering.
At the same time, there were many firms that were cash rich, that were just sitting on cash. And if
I
you
agree.
look at aggregate savings also, household savings have gone down, but savings by the corporate sector have gone up. Any high growth episode that happens, that the companies make money and they don't share as much, so their savings go up.
No, I think if I could intervene,
Sure.
I think one of the things, again, going back to this, oft-quoted House of Debt report, I think the focus really was on concentration risk, not so much the overall, credit, and concentration risk in companies which did not have a track record in areas in which they were participating. I think that bit gets kind of missed out, and we just look at balance company corporate leverage in aggregate terms and so forth. But I correct me if I'm wrong, but Neelkanth, your central thesis was that there was huge concentration risk, and that sort of really led to the problem. So I think we, I'm sorry I interrupted, Ashima, but I think we should need to look behind some of these headline numbers, like the under leverage at a macro level, and look at, in order to get to this leverage, what are we making mistakes in terms of the kind of distribution of credit that is happening and so forth. I think these are just as important in determining the vulnerability and the resilience of the system.
No, so two
Ashima.
things. I think these kind of reports and the attention they receive in the media led to a perception that Indian corporates are very highly indebted, which is not true. There's a lot of diversity there. And second, I think that we were over-reliant on banks for infrastructure financing. Our problem was really we didn't know how to finance these long-term assets, and we needed to do a lot of that. So over the years, as I say that governance standards have improved in the financial sector, diversity has improved. What we are seeing is corporates are borrowing abroad, and the corporate bond market is developing somewhat. That is healthy. For you can play different maturities and requirements, and a lot of people are taking equity now. There are a lot of venture funds and so on, not reliant on debt. In fact, after the NCLT and the IBC and so on, corporates are so afraid of debt, afraid of losing. They're deleveraging. They're like Reliance saying they want to be debt free. So many corporates are, and there's a lot of interest in equity in India. And equity in a way is very expensive long term, because when the economy does well, you pay a lot. So we need a better balance. But I think we are seeing enough financial development and diversity, and we've learned by burning our hands. So hopefully we will do better going forward. This is the thing I want to flag: balance, both in policy. Don't go overboard. Don't be either over stimulus or over strict. And don't focus too much on structural reforms and not on the counter-cyclical and macro parts. Similarly, for corporates, a balance between debt and equity, and so on, and having a good, viable business proposition on the basis of which you get credit, not on the basis of contacts and so on, which used to be the case.
Yeah. So moving on to one final topic, I think before we will have to wrap up. The ability to use external savings. I think this needs to be focused on as a separate area in itself. The latest budget, we saw a concerted move to monetize existing assets by inviting foreign investment funds to invest in these monetized assets, so that the money that was invested in toll roads, power plants, airports, or whatever could be released and redeployed in fresh investment. I think that is a good way of actually leveraging our assets and attracting foreign funds to increase our capital expenditure. But this is only one part. I think given the trillions of dollars of funds that are footloose across the world looking for ways to deploy profitably, this needs special attention. And that the ability of a country with a current account deficit and a huge need for building infrastructure, the ability to draw this footloose savings and use that for our growth is very, very important. A quick round from all of you. I think we have only 5 minutes left. So very briefly, starting Neelkanth.
Yeah, so We need to look at the problem holistically. As you know, if your balance of payments is in significant surplus, your currency will start appreciating. Our current account deficit ratio is now, I mean, for a few months we were printing a surplus. I don't think it will be more than 1.5% of GDP with oil at 60, 65. If it goes to 100, then of course there's a difference. If this is the case, if we get a lot of foreign capital in, our balance of payment surpluses and the pressure on the rupee to appreciate will keep going up. And as the PLI schemes further shift our current account balance, in our estimate in the next 5 years, they themselves can drive a $50-60 billion shift, meaning net exports will improve. Then what are you going to do with external capital? That there will be sufficient financial savings domestically to fund that. But having said that, when we are thinking of foreign forms of capital, you're right, there is very low cost capital available globally. And I think to be able to tap that on the equity side, I think we've opened up as much as we could. I think on the debt side, we can open up further. I think inclusion in bond indices, government bond indices, where so that foreign portfolio investors can freely buy Government of India bonds, and there is a more steady inflow, say $20-30 billion a year that keeps happening. That will also help provide better pricing of Government of India debt. Because right now, the only people who price it are people who hold 1% of the outstanding debt, which is mutual funds and some private bank treasury guys. I think we need more diversity in government bond ownership. So I think those would be the areas I would focus on.
Yeah, I mean, response to that, if there is a greater inflow of capital, there would also be greater economic activity, which in turn would drive up imports and therefore widen the current account deficit.
That is what theory is, right? That the balance that current account is the negative of capital account and all that. But the point is that
in the short run, there could be a mismatch.
And that short run could be several years, and then the US government can start calling you a currency.
Yeah.
I mean, why would someone a currency manipulator if the currency reserves are going up because of capital flows, right? Yeah. But the point is that these things can happen, so we have to be prepared holistically.
Yeah. Abheek on this.
Yeah, just a couple of points. I think again, just getting away from aggregates in terms of the resilience of the external sector. We tend to sort of measure it in terms of FX reserves in absolute terms. But what are the sort of short-term outflows that can potentially happen in response to a risk? And so what is the quality of our reserve position, and whether we can adjust the reserve position by that and actually make a stronger case, as Mr. Das has been saying, as we try to do, for more active intervention, not from the perspective of trying to hold the rupee, as he claims, but to create a buffer for the future. So that's one thing that I think we need to keep in mind. This used to be discussed very actively. I remember 10 years ago, what are the claims against your reserves? What is the short-term portfolio money? What is the hot money that can run away? So if you do an adjustment for that, I think our reserve adequacy is still very low and could be used as a case against anyone who accuses us of currency manipulation. The other thing, of course, is that we are using new institutional mechanisms to attract foreign capital into infrastructure. Infrastructure has been a very difficult area for both domestic and foreign investors to make money in. I hope this DFI is very different from the older DFIs, whose track record has been mixed. So we just need to, I think the bottom line is that we need to have products, durations if you're issuing infrastructure bonds, which kind of sync with the risk and tenor appetites of the larger institutional investors who kind of specialize in areas like infrastructure, who want a constant annuity type flow. We need to sort of sync that and ensure that we are not offering a product that no one is really interested in.
Yeah. Ashima, your response.
I think to attract foreign investment in infrastructure, you need long-term patient money, and so you need better instruments. These rates are good, I think, and also where the government takes some of the risk, the initial risk. And so when they are selling already functioning assets, I think money will come in there. So that way you need, and better, contracts, etc., etc. But at the aggregate level, I think we have to remember that our reserves are all hot money, so to speak. They're not from export surplus. So in that sense, reserves, capital flows must be used. They can't only be accumulated as reserves. Then that is expensive, because you earn zero on US Treasury. You borrowing in order to finance the US government rather than your own. And so also this thing about opening out the Indian, until you're able to absorb, as Harun, you were saying, as the activity level goes up, you can absorb. Until investment goes up as a result of these inflows, they're not that productive. No? So I always say that, yes, allow more debt flows, but only as a function of the domestic debt market and also international debt to the ratio of 6%, because otherwise your interest rate becomes hostage to fluctuations, and these are the most volatile kind of capital, and you're not able to sustain your domestic cycle. This happened to us in 2013 and in 2018. So we don't want to open ourselves to that until our own domestic market grows enough that you can absorb those shocks and you're able to use those flows productively.
Yeah. Well, thank you. I think we had a flavor of what needs to be done to create a resilient economy. Of course, we couldn't discuss everything threadbare. The pandemic really showed that good politics is actually good economics, because how a government responds and how the economy reacts is constrained by the political economy, right? So the need for social security to take care of the people, the need for a sound health infrastructure, so that if a pandemic kind of a crisis happens, it can be tackled. These are absolutely vital to a functioning economy. Although in the normal course, economic analysts don't really give great attention to these kind of factors. The pandemic has shown how these all come together in terms of an economy and a nation being resilient in the face of a crisis. I think we have not done great, but we haven't done too bad either. And I think as we go along, we'll learn and we'll muddle through, as India has always muddled through. Hopefully, we'll learn better and become even more resilient than we are today. Thank you all.
Thanks, TK. Thank you.
Thank you.
Thanks, everyone.
Yeah.
Bye.
Bye.